The inverted hammer at bottom is a notable pattern in technical analysis that signals a potential bullish reversal, especially when it appears after a period of downward market movement. This pattern is characterized by a small body at the lower end of the trading range, with a long upper shadow and little to no lower shadow. The appearance of this pattern suggests that despite selling pressure during the trading period, buyers managed to push the prices up, closing near the opening level. This reflects a shift in market sentiment from bearish to bullish. Embracing the potential of the inverted hammer at bottom involves understanding its implications for future market movements. When this pattern is identified, investors might see it as a sign that the market's downtrend could be losing momentum, and a reversal might be on the horizon. Therefore, investors might consider this pattern as a cue to potentially adjust their investment strategies, perhaps by exploring buying opportunities in anticipation of an upwards market movement. It is important for investors to combine the insight from the inverted hammer at bottom with other analysis techniques and market indicators to make informed decisions. Relying solely on one pattern might not capture the full picture of market dynamics. By incorporating additional analysis, investors can enhance their understanding of market trends and refine their investment approaches accordingly. In conclusion, the inverted hammer at bottom is a valuable pattern for investors looking to identify potential turning points in the market. By recognizing its significance and integrating it with a comprehensive analysis approach, investors can better position themselves to capitalize on emerging opportunities as the market sentiment shifts from bearish to bullish. The shooting star is recognized as a bearish reversal pattern that typically emerges at the peak of an uptrend, signaling a potential reversal in the price direction. Imagine seeing a candlestick on a chart where, after a period of upward price movement, there's one with a long upper shadow, a small lower body, and little to no lower shadow. This resembles a shooting star falling from the sky, hence the name. The formation of the shooting star is significant because it forewarns traders and investors of a possible change from bullish to bearish sentiment. Its long upper shadow indicates that during the trading period, buyers managed to push the price up, but ultimately, sellers gained the upper hand and pulled the price back down, closing near the open. This tug of war suggests that the buyers are losing control and that the sellers are starting to dominate, which could lead to a downward trend in the price. For the shooting star to be considered a valid bearish reversal indicator, it should appear after a prolonged uptrend where the market has consistently been pushing prices higher. Additionally, its presence should be confirmed with subsequent trading days showing lower prices, further validating the reversal signal. Understanding and recognizing the shooting star pattern can be a valuable skill for those navigating the financial markets. It allows for the anticipation of potential market downturns, offering an opportunity to adjust strategies accordingly, whether by taking profits before the prices fall or preparing to enter the market at a more advantageous position. Identifying the shooting star at the top of an uptrend involves looking for a specific candlestick pattern. This pattern is characterized by a small body at the bottom with a long upper shadow and little or no lower shadow. The small body indicates that there was not much movement from the opening to the closing price during the time period, while the long upper shadow shows that buyers drove the prices up, but sellers later pushed it down, closing the session near the opening price. This formation suggests a potential reversal from the prevailing uptrend because it represents a struggle between buyers and sellers where sellers are starting to gain ground. For the pattern to be considered a valid shooting star, it must occur after a significant uptrend, and the next day should confirm the bearish reversal with either a gap down or a lower close. In summary, the shooting star pattern signals the possible end of an uptrend, suggesting that it might be time for investors to consider taking profits or preparing for a potential decrease in prices. It is a helpful tool for traders and investors, enabling them to make more informed decisions by analyzing price action and market sentiment. The shooting star at the top is recognized as a bearish reversal pattern that typically emerges following an uptrend in the market. This pattern is marked by a small body at the lower end of the trading range, with a long upper shadow and little to no lower shadow. Essentially, this shape resembles a shooting star falling from the sky, hence the name. The significance of the pattern lies in its ability to indicate that, despite the market opening lower and making a push upwards throughout the trading period, selling pressure eventually overtakes buying pressure. This sell-off towards the end causes the market to close near its opening levels. In the context of deciphering market sentiment, the appearance of a shooting star after a period of positive price movement suggests a potential shift in investor psychology from bullish to bearish. Investors interpret this as a sign that buyers are losing control and sellers are starting to dominate, potentially leading to a downturn in the market. This shift is particularly poignant if observed after a prolonged period of upward trend, indicating a more significant potential reversal. Understanding and identifying patterns like the shooting star can equip investors with valuable insights into future market movements. However, it is also crucial to consider other factors and market conditions, as relying solely on one indicator might not provide a comprehensive view of the market's direction. The shooting star at top pattern is a signal in technical analysis that may indicate a bearish reversal, particularly after an uptrend in the market. This pattern gets its name because it resembles a shooting star in appearance. It is characterized by a short body located at the lower end of the trading range, with a long upper shadow and little or no lower shadow. The nature of the pattern section delves into its role as a herald of reversal, emphasizing its significance in suggesting a potential change in market direction. When this pattern appears after a sustained period of rising prices, it suggests that the buyers initially continued to push the price higher during the session, but by the close, the sellers had taken control and pulled the price back down to near the open. This shift in momentum is taken as a warning sign by traders that the bulls may be losing their grip on the market and that a downtrend could be on the horizon. To identify a shooting star, look for a candlestick with a long upper shadow that is at least twice as long as the body, and a small body near the bottom of the trading range. The color of the body can be either red or green, as the key indicator is the relation between the open and close prices, not necessarily the direction. However, a red body enhances the bearish interpretation. For investors using this pattern as part of their analysis, it is advised to look for confirmation before making any trading decisions. Confirmation might come in the form of a gap down or a long black candlestick on the following day, indicating that the bearish sentiment has continued and validating the reversal signal provided by the shooting star pattern. Understanding these patterns and their implications requires attention to detail and experience in market analysis. However, recognizing a shooting star at the top of an uptrend can be a valuable skill for traders looking to anticipate reversals and adjust their strategies accordingly. After identifying a shooting star pattern at the top of an uptrend, it is crucial to confirm the signal to ensure its validity as an indicator of a potential bearish reversal. The shooting star is a candlestick with a small lower body, little or no lower shadow, and a long upper shadow. This pattern suggests that buying pressure at the beginning of the session was overcome by selling pressure by the end, indicating a shift in momentum. Confirming this signal involves waiting for additional bearish confirmation following the appearance of the shooting star. This confirmation could come in the form of a gap down, a long bearish candlestick, or closing prices lower than the shooting star in the subsequent sessions. Verifying the pattern's bearish reversal signal through these methods can help investors make more informed decisions and potentially safeguard against false signals. The shooting star pattern, when it appears at the top of an uptrend, is often viewed as a bearish reversal signal. This pattern emerges when, during a period of upward trend, a candlestick forms with a small body near the bottom and a long upper shadow. This shape indicates that during the trading session, buyers initially pushed the price higher, but ultimately, sellers took control and drove the price back down, closing it near the low. The presence of this pattern suggests that the momentum behind the uptrend may be waning and that a possible trend reversal to the downside might be on the horizon. The reliability of the shooting star signal, however, depends on several factors. For one, the context within which the pattern forms is critical. A shooting star pattern that occurs after a sustained uptrend is more likely to signify a meaningful reversal. Additionally, the volume of trading during the day the pattern forms can also influence its reliability. Higher volume on the day of the shooting star indicates stronger seller pressure, reinforcing the potential for a bearish reversal. Furthermore, confirmation from subsequent trading sessions, such as a follow-up candlestick closing lower, can provide further evidence that a reversal is likely. It is crucial for traders to consider these aspects when interpreting the shooting star pattern. While it can serve as a useful indicator, it is not infallible, and relying solely on this pattern without considering other market factors and signals could lead to misguided investment decisions. As with any technical analysis tool, the shooting star pattern should be used in conjunction with other indicators and analysis methods for a more comprehensive market assessment. The shooting star at top is recognized as a bearish reversal pattern that typically emerges at the end of an uptrend in a market chart. This pattern is identified by a small body at the lower part with a long upper shadow and little to no lower shadow. It suggests that the buyers initially pushed the price higher, but the sellers later took control and pulled the price down, closing near the low. This change in momentum can signal that the uptrend may be losing strength and a possible reversal to a downtrend could be imminent. When combined with other technical analysis tools, the effectiveness of the shooting star pattern can be significantly enhanced. For example, if this pattern appears at a strong resistance level, it can provide additional confirmation that a bearish reversal is likely. Technical analysts might also look for convergence with indicators such as the moving average convergence, divergence, or the relative strength index to validate the bearish signal. The use of volume analysis can also complement this pattern, where higher trading volume during the formation of the shooting star fortifies the bearish reversal signal. In essence, while the shooting star at top is a powerful standalone indicator of a potential bearish turn, its predictive capability is magnified when employed alongside other technical analysis tools. This synergy helps analysts and traders achieve a more holistic view of the market and make more informed decisions about their trades. A shooting star at the top of an uptrend is known as a bearish reversal pattern. This pattern emerges when, during an uptrend, the price opens, advances significantly during the session, but then closes near the open price. Visually, it appears as a candlestick with a long upper shadow and a small body at the bottom, resembling a shooting star falling from the sky. This pattern indicates that although the buyers pushed the price up, the sellers eventually managed to pull it back down to near the opening level, suggesting a potential shift in momentum from buyers to sellers. Navigating the pitfalls associated with the shooting star pattern requires careful attention. First, it is important not to jump to conclusions based on a single candlestick pattern. Confirmation from the next candlestick or additional indicators is crucial for validating the reversal signal. Investors should also consider the volume during the formation of the shooting star. Higher volume can provide greater confirmation of the pattern. Additionally, it's beneficial to observe the broader market context and other technical indicators to ensure the pattern aligns with the overall market sentiment. In essence, while a shooting star pattern can signal a bearish reversal after an uptrend, investors should proceed with caution. They should seek confirmation through subsequent price movements and integrate this signal with other technical and fundamental analysis to make well-informed trading decisions. The shooting star is a bearish reversal candlestick pattern that typically appears at the top of an uptrend. Imagine looking at a candlestick chart where most candles are green, indicating prices are going up. Then you notice a peculiar formation, a candle with a small lower body, a long upper shadow, and little to no lower shadow. This is the shooting star. It signals that during the trading period, prices soared high, but then faced pressure from sellers pushing it back down, closing near the low for the period. This tug of war hints at a possible change in market sentiment from bullish to bearish. When we talk about strategic applications for investors or traders, spotting a shooting star after a consistent uptrend can serve as a cautionary tale. It suggests that the bullish momentum is potentially weakening and that a price reversal to the downside could be imminent. Investors might consider this an opportunity to take profits on long positions before the anticipated downturn, or for traders to initiate short positions to capitalize on the expected drop in prices. However, it is crucial to wait for additional confirmation before acting, as relying on a single candlestick pattern can lead to premature decisions. Confirmation could come from subsequent bearish candlesticks or a drop in prices below the shooting star's low. Moreover, integrating other technical analysis tools such as volume indicators or moving averages can provide a more comprehensive view, enhancing the decision-making process. In essence, the shooting star is not just a pattern, but a narrative of a shift in market dynamics, signaling traders to reassess their positions and strategies in light of emerging bearish tendencies. The shooting star pattern appears at the top of an uptrend, signaling a potential bearish reversal. This candlestick pattern is characterized by a small body at the lower end of the trading range, with a long upper shadow and little or no lower shadow. It resembles a falling star lighting up the night sky. The small body indicates that there was not much difference between the opening and closing prices, while the long upper shadow signifies that the price was pushed up during the session but faced resistance, closing near the open. Exploring variations of the shooting star pattern involves understanding that these can differ in their reliability and appearance based on the preceding price action and market conditions. For example, a shooting star with a very long upper shadow might indicate a stronger rejection of higher prices compared to one with a shorter upper shadow. Similarly, if this pattern occurs after a more pronounced uptrend, it might suggest a more significant potential reversal. Furthermore, when analyzing these patterns, traders often look for confirmation in subsequent sessions, such as a gap down or a long bearish candlestick, to validate the bearish reversal signal. Understanding the nuances of the shooting star pattern and its variations requires observing not just the shape of the candlestick, but also the context in which it appears. This includes factors like the strength of the preceding trend, the volume during the formation of the pattern, and market sentiment. By analyzing these elements, traders can better gauge the likelihood of a reversal and make more informed trading decisions.